Hello, Roger Stevenson here again from Cooperators Insurance. I am the financial advisor and owner of the agencies located in Three Hills, Drumheller, and Bicycle. Continuing on with our educational videos on some topics that we think are worth discussing amongst our farm clients. Today we're going to talk about deductibles and what is the right deductible amount for you. Pretty sure everyone understands what a deductible is. Simply put, it's how much of any given loss you're prepared to pay before the insurance company steps in. Everyone has a deductible. It's understood, but the thing that isn't understood is where your deductible really should be for you. The idea that the higher your deductible is, the more you save. Yes and no. You need to do the math. You need to get your advisor to run the numbers. There's often a sweet spot where you get the most bang for your buck. Example, going from $1,000 deductible up to a $2,500 deductible might have a significant amount of savings in some cases, but then going from a $2,500 to a $5,000 deductible might not have very much savings at all and isn't worth it. So it isn't necessarily that you're going to save money by increasing your deductibles, at least not to the amount to make it worth taking on the additional risk. So it's definitely something you need to work through your advisor and just ask for examples and find out where you're going to get the biggest bang for your buck. The main question when you're talking about your deductible is how much can you afford to pay? Insurance is there to protect you financially in a time of loss. You need to calculate how much risk you're willing to take, what a reasonable amount would be that you can take on. It doesn't matter how high you make the deductible if the amount that you pick is too much for you to financially take. So you need to come up with a number that is a number you're comfortable with, allowing you to decide that that's the amount of risk that you're personally willing to take. So what if you sit back and you decide I can afford a $10,000 deductible? Does that simply mean that I should make my deductible $10,000 because I can afford that? Not necessarily. Remember, the higher your deductible goes, the higher your threshold for a claim will now be. So if you have a $10,000 deductible, and because you think you can afford that amount, and now you have a claim for $12 or $13 or $15,000, are you going to put that claim in when you have a $10,000 deductible and your net claim is only going to be $5,000 or $2,000? So you really have to think about that, where your deductible is going to sit and what that's going to do to any claim that you would put in that is close to where your deductible is. So you saying I can afford a $10,000 deductible, in my opinion, now it means you're not putting in a claim for 12 or 13,000, because why would you put in a claim for $2,000 or $3,000? You have to really think about that. The other thing you want to think about is that you do want to protect your claims history like it's your credit score. Your claims history is a significant dictator of your future rates. As rates continue to climb, you want to be seen as an excellent risk. So protecting your claim, only putting in claims that you need to. Now, I've heard lots of people say, I haven't put in a claim for 30 years. And I want you to think about, you're thinking about how much money you've paid into the insurance company over those 30 years. So why wouldn't you put in a claim? And I want you to twist your head around a little bit and think about it this way. Every year that you put premium into the pot, that you didn't use that premium for a claim, someone else did. Okay. So when you have a claim, when you have a total loss fire, you have a building collapse, you have a payout on that claim of hundreds of thousands, sometimes $1 million in a payout on a claim. That individual, throughout the whole life of that building, never would have paid the insurance company anywhere close to the total amount that was paid out. So in those situations, the money coming to pay that claim came from everybody else's premiums around them to pay that claim. So yes, you didn't use your money when you put it in each year, but someone else did. The vast majority of times, the insurance company pays out almost all the money they collect in premiums, sometimes more. When you think about a situation like the hailstorms in Calgary or the Fort McMurray fires, that money to pay those claims not only came from the surrounding people around it, in some cases it came from the entire province and the entire country to pay those premiums. So way to think about it a little bit that way. But bottom line, decide how much you're prepared to self-insure, protect your claims history so that you can help yourself have the best rates going forward. This is where we come back to. So your self-insured amount, you sit and you think about how much you can afford. And I said before, that doesn't mean that's what your deductible would be. So if you sat back and say, I would never put in a claim for $5,000, $5,000 is my limit. Anything under that, I would self-insure for. That doesn't mean that you want your deductible to be $5,000. Because again, you put a $5,000 deductible, you have a $6,000 claim. Are you going to put in a claim for $1,000? No, you're not. So $5,000, maybe the right deductible for you is $1,000, even though you'll never put in a claim for less than $5,000. Okay, and that's coming back to figuring out where the deductible is going to be the right bang for your buck, comparing your deductible to the amount of money that you're willing to claim or that you're willing to pay, and kind of doing some math. Once you have the right number, as I said, talk to your advisor, get premiums for different deductible amounts, find that sweet spot, factor in what your deductible is going to be on your max payout, and work with your advisor to come up with the best return of your premium and understand where your self-insured amount is going to sit. As I always say, the most important thing to do is regular reviews of your policy with your advisor. Sit down, review your limits, review your deductibles. I would even say that from time to time, review what the impact of the premium different deductibles will be, because you could review all of your deductibles 1 year and review the impact on premium by increasing or decreasing. And 5 years later, you can do the same thing and find out that the rates have changed and the impacts are different with different deductibles. So playing with deductibles is always something you want to do in your reviews. And as always, we're here to answer any questions that you might have about your policy. We try to review our policies with all of our clients on a regular basis. We'd review your policy with any company that you're with to give you some advice, some questions to ask, and we'd be happy to review everything with you. So reach out, give us a call. We're here to help. Thanks for listening.